Thank you all for joining us for a weekly tax update. My name is John Shealey. You're joining us for episode 82, the week of August 18th, 2023. Quite a lot to talk about today. So let's go. I won't waste your time. This is also a supersized episode, as we've had lately. A lot going on. We're winding down the real estate program next week, but September and October promise to be full of representation programs. The preliminary class list is up. By all means, if you're not a subscriber, you should be. Our weekly support program has one seat available if you would like it. Live question and answer sessions with myself and Ellie Jones this time of year during Fridays for 90 minutes from 1 to 2:30 p.m. Eastern time. During tax season, we add an additional 2 hours on Wednesday evenings because we get international questions. I'm joined by Rita Ryan, my favorite attorney, or one of my favorite attorneys, and Susan Anderson from American Expat Tax Services. And we handle all of your questions, whether it's tax prep, tax practice, employee issues, anything, so occasionally a software issue. So by all means, if you need that level of help, if you work by yourself or you have a practice where you're the only professional in the practice, this might be a program for you. Let me know. We said real estate is winding down with a couple of programs next week. Brian Coddington makes his annual pilgrimage to do his 3115 for real estate program and cost segregation for tax professionals. Two really great programs that I think you should join us for. I will be speaking on real estate professionals, always a fun topic. But September and October bring us representation, something that enrolled agents, CPAs, and attorneys can do before the Internal Revenue Service. AFSPs have limited representation rights. That's a conversation for a few minutes from now. Preliminary programs through October 24th are posted. We're trying to do both early career and experienced people, both examination and collection programs. Typical things you'll normally see, things you might not see. Some of these programs are fabulous. Roger Nemeth is going to join us for the first time. His father, Bill, has been with us for a few years, but Roger's going to come on. Jessica Smith has been on coaching programs with me. This will be her first class for me, I think. Amy and Jane, you both know. Sal Candela is a big speaker was at NTPI. He's going to join us to do his Freedom of Information Act class. Jeff Purdy, first-time speaker for us, is also going to come on board, talk about the Internal Revenue Manual. And for a first time, we're going to do a class on representing the taxpayer who's lost their passport or is in jeopardy of not being able to renew their passport. And Ellie comes back. Kimberly, by the way, is Ellie's secret name. And Ellie will be with us to do earned income credit audits and correspondence exams. She's done both for us before. Also great program. So we're trying to meet everybody's needs here with respect to representation. September 12th, Frank Agostino's Trial of a Time Lord, or Trial of a U.S. Tax Court Case, Part 1. On practice and procedure. That begins September 12th, 6 p.m. You can join us live in Hackensack, free pizza, 3CE, 3CPE. If you don't want to travel down to Hackensack, you can watch it online, and we'd be happy to have you. No pizza, but also IRS and NASBA CE, CPE available for attending that program as well. The IRS has approved our annual federal tax refresher program. You can take the 6 credits with us. You can take the AFSP exam with us. If you would like to do this right now, the self-study program is available. You can take a look at the book and take the 100-question timed exam online. At the conclusion, we can award you 6 credit for AFSP, and you would be able to use the AFSP designation next year. For those of you that would like a more personalized learning with a person in the room across the screen from you, Nicole is going to teach November 7th, 8th, and 9th, 2 hours each day. You'll get your 6 hours done that way. then you can take your exam. First 10 folks who pass the exam, we have a gift for you. So please consider. International Tax Conference, 10th annual conference is in New York City again this year, October 30th, November 1st, November 2nd. We would be pleased to join you. Registration is up, as is the agenda. I will be in Massachusetts for the Massachusetts Rhode Island chapter of NATP. Programs are listed. They don't have their registration link up. It's October 11th, not the best date, but this is based on the venue's availability, and that it's a great venue, stadium seating, great chairs, and I think it'll also be available online if you want to catch me online. We'll see what they're doing with this. As I have the registration link, I will share it with you. Oh, IRS operation numbers. They caught up. If you remember last week they didn't post some of the numbers. So big change this week is that they're saying that they have processed all of their 2021 returns. Right here, processed all 2021 returns and earlier that had no errors. So that popped up this week as a first time notice. So we're still in yellow here because this represents 2 weeks worth of numbers, because this part of the service centers did not update last week. So we didn't have numbers. So there's 1.71 million returns in inventory. They're down 440,000 over 2 weeks. They include 2020 and 2021 returns that are late filed or need some level of review. There are 1.5 million of those returns in error correction. That's only down 100,000 over 5 weeks. Now remember, net, as they're cranking through those paper returns, they're probably increasing the error correction, especially on 20 and 21 returns where there were EIP credits, right? And the advanced child tax credits generate all sorts of errors. So the fact that it's down at all is fabulous, because when you look at the next number, they have 213,000 paper returns in inventory, which is pretty great. Down 335,000 in the last 2 weeks, 800,000 in the last 4 weeks. To me, this means that now that the IRS, first they got caught up on the 941 amended returns. Everything they have now is 90 days or less of inventory. It's caught up. They're focusing on paper returns. They're getting paper returns out. They're not even focusing on error correction. They're focusing on getting the paper inventory down, right? For the first time in 3+ years, it's going to be down. So that's where this focus is. 1.14 million unprocessed amended returns, 1040X, down 60,000. Still telling us more than 20 weeks. Now, the 941X, 505,000 as of August 9th. That is down a net of 6,000. I don't know about you. I got 3 different ERTC mailers. They're back to the 1990s, direct mail. They're pulling off of the PPP, which is publicly available. So they have the PPP loan data, and they're saying based on your PPP loan, you're entitled to $260,000. I can't wait to get that check. I'm going to buy myself a Maserati. Hopefully I buy some insurance with it too. But Commissioner Warfel had said they were going to process 20,000 of these returns a week during tax season and get to 40,000 a week right now. Remember, they were as high as 1 million returns December 31st. They got it down. It's pretty stable right now. What's coming in is what's getting out. So 90 days here worth of stuff. We know they're screening out a large number of returns now as well, fraud returns. And this is the second week in a row I forgot to post about that guy in New Jersey. Let's see if I remember to talk about him, even though I didn't include his material. Emphasis seems to be on paper 1040s. Again, my opinion. Seems to be on paper. I am occasionally using AI to summarize some of my articles. My prompts must not be as good as I would like, because I'm not always pleased with the results, and I end up redoing or adjusting the bulk of the work. Happy birthday to the Inflation Reduction Act. It is the first birthday, and they issued a report card. It's not Mr. Warfel's first birthday, but it's the first birthday of the Inflation Reduction Act. So they put out a report card, And this was in the form of an information release, an IRS press release, 2023-148. I believe there is a link to it in your, in addition to the handouts, by the way, there's a bunch of handouts this week. In addition to the handouts, I gave you a resources sheet. So it's on the resources sheet. If you can't find that link, by all means, email us. We'll get you the link. So the IRS delivered dramatically improved 2023 tax filing season service, so they say. They've modernized technology, and they are chasing high-income people, which are defined as people that make more than $400,000, apparently. Big new milestone in paper processing. 225 times the number of forms were scanned in 2022, then in 2023, then in 2022. I'm going to ask you to hold that thought. They started with a low number, and remember, it was 940 and 941. And then when I read the article further, that's exactly what I found it. That's exactly what it was. My memory was correct. They've added 51 additional forms and letters that are available for online response. That brings the total to 60 from the 9 that you could do last year. This, of course, assumes you can get into that Tax Pro account, that self-created account that our clients can't get into, that, according to Roger Nemeth, 1,000 POAs a month are all that run through that thing. So it's not quite the success they had expected it to be. Big improvement the IRS touted themselves for was the callback option. They're saying better serves taxpayers during high call volume. The customer callback option will now be available for up to 95% of callers seeking live assistance. They made a decision that anything that's a 15-minute or less wait, they weren't going to offer callback feature for that. Just by the time you do it, did you really save anything? But anything above 15 minutes, callbacks are available. So sometimes you have to take what the IRS is telling you with a grain of salt. So I'm going to show you a few things where the IRS is saying something in this press release, and there's other things out there that we found online. So first, improved phone service. Phone times were cut from 28 minutes to 3 minutes when they answered the phone. They answered 3 million more calls. I could not find the definition of answered a call. Bear with me. They cleared the backlog of 2022 individual returns. I'll give them that. They launched online returns and direct deposit for amended returns. I'll give them that. But if you look here, 2019, all right, so 2020, pandemic, right? They're answering about 20% of calls. 2021, they're answering about 10% of calls, and that pervasive, right? Where's my money? Where's my money? Where's my money? As the pandemic comes to an end, they've added technology. They've added the call centers in the Mississippi Delta and out in Puerto Rico. We gave them $80 billion. We gave them an increase in the current year budget. All of a sudden, we're answering a lot more calls. And I guess FEMA needs a lot less operators too, maybe. I can't get that statistic yet. I'm looking for it. But now this is coming from the Tax Foundation. So this article here, so over here, this is what the IRS released in their information release. What you see here comes from our friends at the Tax Foundation. Everything on the Tax Foundation website is free. They are bipartisan and generally unbiased with the information they deliver. So they're saying here, they're agreeing there's an improvement, but they're saying it's a decrease in demand. So 2019 over here, 2023 over here. What happened? So yeah, 20 and 21, we're looking for all these people. Right now, we're back to what Commissioner Werfel and before him, Commissioner Reddick would have said were a more normal inventory, more normal demand level. Again, these are numbers during the filing season. All right, so this is the IRS numbers. They said they scanned 849,000 forms, which is 225 more than last year. Well, if you look at the 160 million tax returns or documents they get, that's not a whole lot right now. The 225 times more is impressive, but take a look at some of the numbers. 481,000 forms 940. Well, we knew that. We've talked about that before on this program, that what they've done is all 940s that are mailed in on paper by you cheap tax preparers and these self-employed people at home that don't use payroll service, that are mailing them in still. Previously, they were key punching them. So now they're scanning them. It's a very simple form. It doesn't get much simpler. And what they did was, rather than create a whole new set of software, once that thing is scanned in, it converts it to an e-file return, and it e-files it to itself, if you will. So the service center sends it in as if they were an electronic return originator, and out goes that Form 940. Same thing with the form. So every 940 went in that way, right? No paper 940s in theory. They're looking at some 941s. They had 300,000 go in. The big number is 64,000 Forms 1040. You say to yourself, that's it? Yeah, that was it. 64,000. So IRS aims to process all paper returns digitally by tax season 2025. Now, this is what Aaron Collins had been telling us, had been asking Commissioner Rettig for. And he had said, can't. I guess that $80 billion helps. They're spending that money and they're putting it into technology. The customer callback option is going to be available for 95% of callers. Now, this is John's question, which I hope will be answered by a Freedom of Information Act request. Does offering the call back count as an answered call? I got into the queue and your computer said, would you like a callback? Bing, yes, I would. Now, do they count them when I don't take the callback? Because a lot of times when they tell me it's going to be 30 minutes for my callback, I'll break out the wallet and use call and queue again, right? But we always try to make that initial call first. So not clear to me, but I am wondering what counts where, what the methodology is. We'll find out, right? All right. So they're reaching more taxpayers. This has been a concern since they created the Taxpayer Experience Office. Maybe it was a concern before this, which is why we have the Taxpayer Experience Office. All of this comes out of the Taxpayer First Act. And there are underserved areas around the country. Now, I think this is great that they've gone to a bunch of places like Paris, Texas, Hastings, Nebraska. They're going to go to Juneau, Alaska. I can't pronounce Lahu, Hawaii. I think this is great, but going to see me once every third year, once every other year, I don't understand how that's going to help me if my problem is today. And they shared some success stories in the literature. Don't get me wrong, but this is also the same when the IRS went to a taxpayer assistance center in Washington, D.C. a few months ago to test the Inform Me app. And they also posted some success stories that it works. But, you've got to have everybody everywhere looking for this thing to really say, hey, look at what we're doing, and this is great. So I'm not sure yet how these pop-up centers are going to help unless they're going to tell you every third Monday, every other Tuesday, we're going to show every other Tuesday morning, we're going to show up at this library in this place and help people. Hired 700 new people to open up these centers, open up the regular call center, the regular tax. There were still some of them taxpayer assistance centers that weren't open. Now they're all open again. So voice bots and chat bots are providing assistance. Now, we heard this last summer. I talked about this on this program, right? So, securing right now, they secure account transcripts, get answers to questions about balances due, and getting help from the Taxpayer Advocate Service. Jason Statz would be very, very proud of the Internal Revenue Service because they're creating the killer app that he said, right? That, accountants who don't use AI are going to be put out of business by accountants who do. Well, the other killer app is you take an AI and you put it on top of the universe of data. Don't let it go to the whole internet. So 1.3 million taxpayers, 13 million taxpayers received some piece of information from the bot. 24,000 established payment plans. That's really killer, right? So two interesting things. So first, it's calling you up and saying, and I've done this, right? But you're calling up for a payment plan. Hi, would you like a payment plan? You owe money. So you owe money. Would you like a payment plan? How is that working? On the one hand, that's great if it's offering the minimum payment, right? Hi, would you like to pay, your balance divided by 72? But is it always offering the best deal? Is it also offering options? If you can't afford this, you can be represented by someone, so it's great that they're using this tool, but at some point, is it going to have to say, are you aware you can be represented? Please say yes. Are you aware that if you only pay the minimum, it's like a credit card and the interest will keep running? Please say yes. So we'll see how well this goes and where we end up. But right now, that's my thinking, that it's good, but where's it going? So they're happy to tell us that they're spending money to make money. So through increased enforcement efforts, they recouped $38 million in delinquent cases, 175 cases from CID. Now, Mark Dombrowski has previously reminded us, when CID sends out their annual report, that CID chooses the cases they pursue. So that's why they have such a high success rate, right? They decided low-hanging fruit, big money, let's go get this guy. They're also using the enforcement dollars to scrutinize the Puerto Rico benefits and foreign pension schemes. So the Puerto Rico benefits are basically, if you're a bona fide resident of Puerto Rico, you don't pay U.S. income tax. It used to be called Act 50. Now it's Act 60, I think. So they found 100 people who are allegedly using the Puerto Rico exemption without meeting the correct criteria. So they're going to prosecute these folks. They're also talking a lot about the Malta pensions. Now, I have to be honest with you. I emailed out Frank, Rita, and if you don't know, Ruth Mattson, who speaks for us occasionally on foreign trust issues. I emailed all three, and I said, are we seeing a lot of these Malta pension things? Should we do a webinar? Is there 50 minutes of material? Are we going to see all of a sudden people walking with paperwork and saying, yeah, I need you to do that malted thing for me, man, so I don't pay a penalty? All three of them who do work extensively with international taxpayers with this type of thing, all three and all attorneys, all came back and said, maybe I saw one once, maybe another law firm asked me a question. So it's nice that they're promoting this, and it is a bad thing when people were using this alleged strategy, which basically takes advantage of the U.S.-Malta tax treaty to put your money in Malta and call it a pension, take a huge deduction here. Doesn't work. And now they're going after those people who did it. And we also have an increased focus on millionaire non-filers. They want to catch the wealthy who don't file. Well, with the old technology, AUR was identifying cases of multi-year, seven-figure, and in some cases eight-figure Forms 1099-K that didn't file an income tax return. Now, at the time, TIGTA had said to the Automated Underreporter Unit in Holtzville, why aren't you going after these people? It's low-hanging fruit. You know, if you've got $10 million worth of gross income, you must have paid some tax or owe some tax. Nope, we're too busy. We can't process all of our cases all of the time. So I just think this is interesting. And is it newsworthy? You know, what are they doing here? So much for the Inflation Reduction Act and its one-year birthday. So there's a new group in town that's advocating for IRS funding and direct file. Couldn't find out who's funding this thing. Coalition for Free and Fair Filing, supported by Democrats in D.C., advocating for IRS efforts to create the free online direct filing tool. A couple of the prominent Democrats that stood up at the press release with them. Group's mission is to ensure taxpayers can easily file, and it said, get the credits they are entitled to. So I just wonder if the group who wrote that was biased. And I don't know whose words they were, if it's where I was reading this material, or if in fact it was in the press release. I couldn't find the press release in time. So I don't know. So I left entitled off there, but I hate the word entitled when it comes to taxes. Democrats want continued IRS funding at the current levels, including this project. Republicans want to reduce funding and have made statements that basically they think that the IRS as tax collector, tax preparer, and auditor are a bad thing to put them all together. So, all right. So this is proposed, big thing, proposed, right? But file this under in case you hear them ask. In case the clients ask. So, Child Care Investment Act would take to their credit the existing tools we have and amplify them a little bit. So they want to increase the dependent care FSA to $10,000, $2,000 for each additional dependent. So in other words, $10,000 for one child, $12,000 for two children, etc. The $5,000 cap is unchanged since the 1980s. Now that's true. My daughter is going to be 21 in a few months. And when she was an infant, I used this. So it was a $5,000 cap. So Certainly hasn't changed this century. So I think that this is a good idea. Use existing mechanisms to directly assist the parents and the employers. Make the child care credit fully refundable. Remove the phase-out cap and increase the percentage credit from right now it scales from 20% to 50%. Now they want the bottom to be 35%, and potentially everybody with a child care expense will get 50% as a credit. Credit would be fully refundable. So it's very interesting. Big challenge here is the cost. Even if you can get both sides on board, it's an expensive proposition. So the Inflation Reduction Act, just back to that for a minute, gave us a corporate minimum tax. It was supposed to be a 15% minimum tax, and the act didn't say what they wanted done. It left it out for Treasury to write regulations for it. So Treasury's still debating what they want to do. In other words, what income will go into the calculation of the corporate alternative minimum tax, and what policies do they think it should apply to? What are we looking to do? Of course, there's a lot of lobbying, including corporations that are saying, we really don't want to see this, So there's hope, talk in Washington, Politico, and a couple of things I read, that they think they're going to release regulations by year end. Probably they're going to release them for proposed regs for comment. We'll see how that goes. We'll see what comes of it. Inflation Reduction Act electronic vehicle incentives are mixed results right now. So first, only 18 of the 97 EVs currently qualify under the Inflation Reduction Act. It's on track to top 1 million EV sales in the U.S. Confusion on the rules, limiting consumer understanding, at least according to the dealers. Maybe people don't want to buy your brand of EV, pal. They all want to drive a cool Tesla. And it's interesting, my comment, this did not make it onto the report card. Oh. So this came, by the way, from something else I read. This did not come from the this didn't come from the report card. All right. The IRS has increased its workforce. Now, the literature I read said that they are nearing their goal of 90,000 full-time employees. I don't know that that's their goal. Improved customer service and scanning from IRA funding. We know that. Employees are less bogged down, but they need continued funding to keep these people. Bob Kerr sent me, if you know Bob Kerr, Bob was the government relations person at NAEA for at least a decade. Then he was executive vice president, and currently he is Kerr Consulting. He became an EA. He is now one of us, which is a fabulous thing. And he sent me an email. He wrote a piece in Bloomberg, an opinion piece. A couple of weeks ago, we covered that the revenue officers are going to stop making unannounced visits, which on the grand scheme of things sounds good. Mark Dombrowski will tell you he wishes we still had the days of the IRS agents seizing cars because it was easier to get work back then. But Bob wrote about the IRS ending the unannounced collection visits, and he had some good insight. On the surface, it seemed reasonable. It protects the employees, protects the taxpayers. But is the IRS missing an opportunity? Unannounced visits put pressure, right? They hand you that business card. You have to engage. I always trained my clients. Hi, I'm represented. I have a power of attorney on file. Please call John Shealey's office, and they give you the phone number. But a lot of your clients don't do that, and that's what they're counting on, right? A lot of clients aren't represented. That's what they're counting on. So unannounced visits put pressure for the taxpayer to engage. If you ever watched The Shield, Forrest Whitaker is always offering a piece of gum to his potential criminals because, if they take that piece of gum, that means they're going to like you. You get them to do something, right? Get them to take the gum. So people will want to engage. Bob says it's unclear if a letter invitation will be as effective, which is what the IRS is saying. They're going to invite people to call. Well, come on. They got into collections because letters aren't effective with these people. So I don't see it being effective. IRS didn't provide details on their alternative collection strategies or the metrics they're going to use to measure the success of the new policy. They just said after 3.5 years of not having field visits, they said, oh, yeah, we're scrapping field visits. So there's nothing to compare to. They don't have any numbers. Improved outreach, case tracking, some sort of data would help everybody understand how the policy is working and maybe make it more effective. Does this send an unintended message that the IRS is pulling back from collections? I don't know, right? That might reduce taxpayer compliance. They already think they're not going to get audited. Now they think nobody's going to collect the tax. A more complete vision, Bob writes, from the IRS, tying this policy to their long-term goals and alternative strategies would help reassure those of us that pay and tax professionals that the obligations are still going to be enforced. It's a link to the full article. It's outside the firewall. So there's a link to the complete article in your resource guide. And Bob is a terrific writer, so you might want to take a read of that if you're interested in the subject matter. Now, speaking of cool, this was cool. So FinCEN, Financial Crime, and Ellie, I meant to email you this. So FinCEN, Financial Crimes Enforcement Network, looks at money laundering and all sorts of bad stuff. Well, FinCEN is going to target the construction industry. So they have a release, 2023-NTC number 1, and I put a copy of that up into the handouts. And they're talking about this evil stuff that's going on in the construction industry. So they want to target the use of, and one thing I want to say here, this is like a how-to guide on how to pull off this scam, because if you didn't know how to do it, they've now put it into the public domain. So FinCEN is targeting the use of shell companies for payroll tax and workers' comp fraud. Here's how this works. A policy is bought to cover a few employees, and it ends up covering hundreds of people. How is that? Okay, so let's think about your business, right, itself. So first, all the bad construction companies get a shell, get this guy together. They create a legitimate construction company, right? And that legitimate construction company buys a workers' comp policy as required in most states from some local insurance agent. Hi, I'm a new guy and I'm starting a new company. So they now have this policy where we say, yeah, I'm going to hire 2 helpers and pay them minimum wage, 20 hours a week. Something really ridiculously low, pay for the policy. If you don't do payroll, don't work with businesses, the way a workers' comp policy is you pay 2 pieces. The expense constant, which is a fixed amount every policy is charged, and then the actual rate based on how much you pay each job category. Somebody in an office, it's like 10 cents per $100 of wages, right? 1/10 of 1%. A roofer, it's like 30% of wages. The comp is ridiculous. Why? People that work on roofs fall down and get hurt. Plus, it was probably a little expensive, so we started committing fraud. We have the same claims with lower payroll. The rates go up. It's just outrageous. So, all right. So now, I've paid a couple of $100 to $1,000 for that policy, and now I'm going to go out and hire all my workers, and then I'm going to rent that policy to other people. Oh, you've got a contract with workers' comp? Hire me as your sub. I've got workers' comp. So the next thing you know, all of these people, it's a legit workers' comp policy. It's going to pay if there's a claim. The problem is that instead of owing $100,000, they paid $1,000, right? It's fraud. So the shell company, as we said, gets the minimal work company, rents it out to other people. Here's how the fraud works now. I go out of business before the first audit. I got no records. I got nothing, and I disappear. Most of the employees are paid off the books by cashing checks at check cashers. And I learned something even more amazing from Ellie last year, I think, from all her experience with the little bodegas that were money transmitters and how to comply with FinCEN regulations. A single member LLC in most states can cash a check that's paid out to the single member LLC. You need to document it correctly. So that's what they're doing. So the notice that's out there details all the red flags that financial institutions and money check cashers and financial institutions should be looking for and what they should be reporting. And this also encourages information sharing to prevent fraud. So very interesting. At some point, there'll probably be a list of bad actors that gets shared. If you are in the New York City metro area, if you're not in the New York City area, I need you to forgive me for 30 seconds. If you are in the New York City metro area, you may recall that the IRS used to have stakeholder liaison meetings where the IRS employee that deals with tax pros. And if you don't even know what I'm talking about, this just tells you what the pandemic and not correctly funding the IRS was. So for every region, there is a stakeholder liaison, an IRS outreach person for tax professionals. They'll be the person that speaks at your local or regional conference. They're the person that does some of the speaking when the Lions or the Elks want a speaker. That this is that person. But this person also would have, depending on the size of the region, at least quarterly, but typically a monthly meeting where they relayed everything that's going on with the IRS to the practitioners. But conversely, practitioners could send feedback to the IRS personnel. In other areas of the country, these meetings have resumed. Now, in some places, they're only online, but they've resumed. Now, I'm on several lists. I know that LA had meetings all through the pandemic. I know that Texas has had meetings all through the pandemic. I'm on those lists. I'm not on the New England list. I'm going to try and get on it. But New York, we don't have a list. So my friend Tom is involved with a group, New York, Connecticut tax professionals. So they have members in both states. And he's aware of and attends the meeting they do for Southern New England. He asked, why isn't there a New York meeting? And the reply is, it doesn't seem to be anybody's priority. He'll take it to management for us, but he wants to know that this is something we want. So if you're in the New York metropolitan area and you would like to see these meetings return, send Mr. McCarthy an email. His email address is here. It's also in the resources page. If you are in organizations, I reached out to state chapters of two well-known tax professional organizations, and I said, would you please ask your downstate members to do this? I don't know if anything's going to happen or not. So I'm asking all of you, if you're in New York or New York metropolitan area and you want this to happen, send Mr. McCarthy an email, please. So the Tax Foundation released a report on 2020 tax returns. And I'm not going to put you to sleep here, but I do want to share a couple of interesting things. So in tax year 2020, taxpayers claim more than 159 million tax credits on their individual tax returns. That's a lot of credits. Worth more than $277 billion, an increase of $35 billion from the prior year, from 2019, largely due to pandemic relief that came through the tax system. Those with AGIs below $50,000 claimed 54% of those credits, $149.6 billion. Those above $200,000 claimed the least, 13%. Largest credit, of course, by number of claims was the child independent tax credit. 39.3 million tax returns, $84 billion. From 1990 to 2020, over 30 years, the value of tax credits has increased tenfold after adjusting for inflation. And this is a great page. Again, comes from that same report, and it breaks it down, which credits and how many dollars. I won't put you to sleep with it. I thought some of it was just really interesting when you see how much money is in credits. Things like the foreign tax credit. Okay, that's not technically a giveaway. That is a obligation we have with our trading partners, and they probably give an equal amount to folks with U.S. source income where we collected the tax. But most of these other things are very interesting in terms of total credits. Did I give you that twice? Yeah. All right. Taxpayers making the most claims. For those of you that need visual, this does show you visual, as you'd expect, right? $58 billion, the single biggest credit, any group, anywhere, earned income credit, right? But that is the purpose of that credit. Child tax credit, next biggest credit here, and the biggest credit in the other three groups is the child tax credit. And here it is as a pie chart, in case graphs aren't your thing, but pie charts are. Right. So thank you, Ellie. Some additional information on the Tax Pro accounts. We told you before the Tax Pro account has the ability to pull transcripts for you. You have to register you have to already have an IRS account, and you have to be registered with ID.me. You can link your CAF number to your account. Now, we're hearing early that all you can see right now are the folks who registered through the Tax Pro account themselves, right? The not power of attorney people. But Roger Nemeth has confirmed that IRS has been saying since the beginning, Tax Pros will be able to see their entire every POA in there. So among other things, I'm going to be able to remove them without actually having to get paperwork and send it in and chase it down. I mean, I have POAs for 2 years. We've been trying to get removed. Every 90 days, we send a new request to remove it, please. All right. Now, you do have to go in now and ask for a PIN. Don't wait till you need this. Go in and request your PIN, and they will send you the PIN. 1 to 2 weeks to get the PIN, right? So that's right here. This nice big box. Step 1, get your PIN. Step 2, later, get your PIN, right? So link your CAF number. I will give you Ellie's number if you need to call her for help with signing up. Oh, and she wrote, "Oh, cool." Very good. All right. So MasterCard, we told you a week or two ago that MasterCard was going to stop allowing payments to run from marijuana dispensaries, state legal marijuana businesses, to run through its system. And they've stopped. Concern right now, will Visa stop? Will Visa halt it? 72% of all debit card transactions in this country run through the Visa network. So this is going to force retailers, marijuana retailers, to take in more cash. They spoke to a couple of different operators. One said that 20% of his business had run through MasterCard, and another said in Arizona said 40%. So right now, these folks are all looking at point of sale systems, payment processors, other solutions. They're all talking about more ATM machines, more cash to count, dangerous stuff, right? We're already seeing longer checkout lines, and it's a less streamlined experience. Why? Because you don't walk up, oh, that's 2 bags of weed, $160. You touch the card, it goes. Now, oh, $160, and you're digging through your pockets, coming up with dollars and change. I mean, these are people that smoke dope, right? So, you know, they're taking that crumpled up Jeff Spicoli money and dropping it on the counter. It has to get counted, folded, and put away. Just like any other business, cash is hassle, more expensive, slower than somebody being able to tap a card. They already have burglaries all over California retailers, and it doubled in 2022. Now, that's partially because there's more cash, partially because laws in certain states, if it's under $1,000, they can only issue you a desk appearance ticket. So folks are more brazen to steal. Unarmed workplace exposes employees to danger. Marijuana dispensaries typically don't have armed guards. Some of these places are installing fog machines to slow things down. They're looking at security procedures, and everyone is looking at monitoring and cash handling procedures. Yeah. Okay, so potential impact now on sales and pricing. More transactions are moving underground. Increased security costs are being passed on to consumers, or if they're not, they will be. There's some impact. Some feel the impact might be overstated. Others say it's going to depend on the cards. I guess they mean the debit cards, right? Further debit card bans are going to threaten accessibility to everybody. I think the big fear now is that Visa pulls the cards, pulls marijuana businesses off the system. If you know anybody looking for a job, the IRS has entry-level positions available. They've asked us to share this, so I did. Now, all they had mentioned was candidates with the required accounting education. Now, I knew that a TCO, a tax compliance officer, the lowest level of IRS employee that would work with you in an exam, needed 6 accounting credits. So I said, I wonder what a revenue agent needs. So I went and I took a look, and it's on their website, usajobs.gov. You actually need a 4-year degree. or with 30 hours in accounting, which is what most states want for the CPA exam. And the 30 hours of accounting, that includes like business law, statistics. It's not 30 hours of debit on the left, credit on the right. 4 years of study, 120 credits, and 30 in accounting, or be a CPA. Any of those things, they'd like to talk to you. You too can be an examiner. Jobs all around the country. If you know anybody, there you go. So we're going to talk about bad tax advice in a minute. Right now, I want to talk to you about good advice. If you don't know Larry Gray, you should. He's a CPA in Louisiana. He speaks for NATP. He represents NATP National at when the IRS asks for when Congress asks for testimony. He testified both for NATP a number of times, and when invited himself, he has testified. So his stuff is always accurate. It's pretty good. He's not going to really make you laugh, but he's going to get you a good amount of content in a pretty fair amount of time. He has a YouTube video right now on why don't you qualify for the ERTC, and I think it's great. It's written towards clients, and it's a good watch. We've put it on social media. I'm thinking of putting it on our own website because we still get calls about ERTC. Personally, I think the government should shut it down this year, but I don't know that that's going to happen. So there's another article, another item I want you to see. Tax notes, federal interview with Tom Cullinan, a retired IRS attorney, also talking about the ERTC. He's talking about the rise in misleading promotions, but also discussing the current IRS response. It's about 35 minutes. It's a podcast. You can either read the transcript that's available or watch the show. All of these links are in the resources page. So download that Word document and you should be able to click your way to happiness. All right, so now bad tax advice of the week. Finally, you folks are sending me advice. So if you come across some advice and you would like to, you think that I should consider it for being the bad advice this week, please send it to me. This week's bad advice, though, comes from Marisa Bartow in Milwaukee, Oregon. And this young lady has a lot of interesting things to tell you.
Okay, I don't know who needs to hear this, and I don't care if anybody feels some type of way about it, but I'm going to put that out there. Did you know that if you bury a loved one in your backyard, that your house now is zoned as a cemetery, and you no longer owe property taxes, as well as you're no longer part of any HOA or any government anything. Your house is a write-off. It's tax-free on any upgrades to your house, and they can never take your house after that. Generational wealth. It doesn't matter if you default on your mortgage or anything like that. They can never take your house from you, ever. They can't take it from your kids. They can never take it. So think about this. Back in the day when you watch things like Wyatt Earp and the movies, they go out back and they bury, their loved ones in their backyard. When did cemeteries become a thing, right? Probably around the first war when we needed money and we instilled war taxes, property taxes, all the bullshit, right? So cemeteries became a thing. Why? Oh, because they needed property tax and they wanted you to pay a lot for funerals. When people used to just do cardboard and, bury people 6 feet under and put them close to their house. But now they have you pay for a plot of land, pay for a tombstone, pay for a casket, put you in debt basically for a funeral to put your loved one on a property that's not yours. Because if you put them in your backyard, then you no longer owe property taxes and your house is no longer owned by the government. I don't know who needs to hear this, but I'm just putting it out there. Just letting you know. I also just wanted to side note that you don't need any government or anybody's permission to do this. You just need a funeral director and a death certificate. And then your house is zoned as a cemetery. You don't need anyone's permission to do this.
Anyway, folks, that's this week's really bad tax advice. Where did my material go? Oops. I'm still here, everybody. Where did my... All right. Yeah, wowie, right? Oh my God, does it have to be a loved one? What if it's a non-loved one? Can I source my own body for burial? Well, then you're in a trader business, right? So we've got to talk about, and you wouldn't be tax exempt. Let's not go there today. My point is, this is the stuff that's out there on the internet. Two things I did not put up this week. Ellie mentioned that maybe we did cover the fellow in New Jersey who had 1,372 fraudulent ERTC claims. I guess maybe we did cover him. I understand that just based on the volume of the crime, it's a mandatory life sentence if you add up all the months, like Bernie Madoff with his, whatever it was, 1,800 months or whatever they gave him in prison, right? Mandated by the size of the crime. Same thing here. So it's a death sentence for this guy. So the other thing is there was a great item circulating around right now, a tax court case. I'll talk more about it next week. But there's some good takeaways from it where these folks, these doctors did business use of the home for their S Corp, right? They paid themselves rent for meetings and used the Augusta rule so that they could not pay tax on it. And at the end of the day, the five of them were deducting like $300,000 for a handful of days of rent off the corporation and not reporting it as personal income because 280A says if you rent your home for 14 or less days, you don't need to report the income. And they got taken out to the woodshed and lost. So we're going to talk about that one next week. Everybody have a great weekend. I'll be here doing tax returns, but I'll be thinking of all of you. Be well.